Welcome to this video on consumption taxes. In this video, we are going to talk about consumption taxes, and we are going to differentiate between general sales taxes and excise taxes. General sales taxes can be further subdivided into retail sales taxes, which are very common in the United States, and value-added taxes, which are very common in the European Union. Note that excise taxes are taxes on specific goods, and here we are going to differentiate between selective, sumptuary, also known as sin taxes, benefit-based, and regulatory/environmental taxes. We are going to look at the sales tax structures, and we are also going to look at the tax evaluation. Now let us have a first introduction to the overview of consumption taxes. Before we start talking about consumption taxes, we have to define what consumption or the related consumption tax is. Remember that the relationship between consumption, income, and savings is that the income plus any change in net wealth, here I have mentioned personal savings, is equal to consumption. So in an ideal world, the consumption tax should be very broad and defined on all types of consumption. However, in reality, this is very difficult to achieve, and it is also very difficult to implement from a financial administration perspective. In reality, consumption taxes are usually much narrower in scope than the ideal tax, in the sense that only certain goods are taxed. The consumption tax can be collected at various production stages. So for example, you can think about a consumption tax at the level of the resource supply, for example, mining and farming, at the manufacturing, wholesale or retail level. Because theoretically, you can consider the situation where a firm purchases inputs from another firm in order to produce something, then theoretically that could be consumption, that can be considered consumption as well. However, in many cases, consumption taxes are only imposed on private households and not on firms. There are two large types of consumption taxes. There are single-stage taxes that are applied only to one stage in the production process, and then there are also multi-stage taxes which are applied to multiple stages in the production process. If you're thinking about the sales tax, for example, in Indiana, then this represents a single-stage tax because it is only applied to the last stage, the retail level, when you are purchasing something. There could also be a single-stage tax, could also be a manufacturer's tax, for example, but as mentioned before, this may actually discourage the production or the movement of manufacturers to other states. Then there's also a multi-stage tax, and here the most common example is a so-called value-added tax. The value-added tax taxes the value added at each stage of production. Okay? Here the tax or the value-added tax is non-cascading in the sense that it doesn't increase from one stage to the other. We also have excise taxes, as I mentioned before, and those are taxes on a single commodity, and they are usually single-stage taxes. If you're interested in the history of taxes, you can also follow this link to a webpage of the Tax Foundation that gives you a little bit of a history of various taxation systems. Now, before we continue, let me illustrate the difference between a retail and a wholesale tax. And it also illustrates how the choice of tax methods can have an impact on the revenue. Consider the setup where we have a wholesale price of $10 and we have a retail price of $20. The markup over the retail price is 100%. Okay? So that means the wholesale price is at 10%. Then if you are having the markup of 100%, that gives you the 20%. Now suppose that we have a retail sales tax of 10%. And hence, if that retail sales tax is applied to the consumer, or the retail price to the consumer of 20%, then the price to the consumer is $22. $20 for the item and $2 of sales tax. Here, in this case, the government revenue is $2. Now, if we have a wholesale tax of 10%, then the price at the wholesale level is not $10, but it's actually $11. 10% for the item and 1% of wholesale tax. The markup of 100% still applies, and hence the price for the consumer is $22. However, in this case, the government has only collected a revenue of $1. Hence, the choice of the tax rate as well as the stage at which to implement the tax or at which to collect the tax matters. Now, when you're talking about the general sales tax, then all personal consumption items are taxed at the same rate. Usually, we do have items that are reduced or eliminated in the sense that, for example, we have food or energy that is exempt from the sales tax. This usually occurs due to equity concerns. Remember from previous videos that low-income households usually have a higher share of their income spent on food and energy. As mentioned before, there is an excise tax as well that is on a single commodity. Here, there are large variations in the tax base depending on what type of excise tax you are talking about. For example, on one hand, you have the federal and state fuel taxes, which has an extremely broad tax base, basically equivalent to all the gasoline and diesel consumed in the United States. But in some locations, for example in Chicago, you also have a plastic bag tax, which has only a very small tax base. Now, we also have a Supreme Court ruling associated with consumption taxes, and this occurred in 2018, and that was South Dakota versus Wayfair. Here, the problem was that South Dakota sued Wayfair for not collecting sales taxes, in the sense that if you were a person living in, or if you were a resident in South Dakota, you ordered something on Wayfair, and note Wayfair is an online shop and does not have any physical presence in South Dakota, then theoretically, if you are the resident ordering something from Wayfair, you have to pay what is called a use tax. However, there is usually the problem that people do not respond or do not report use taxes on their tax return, in the sense that if you're filing for the state income, for the state taxes, then you are not reporting something you have purchased online. It turns out that the Supreme Court ruled in favor of South Dakota, and hence for the entire United States, that now online shoppers or online retailers have actually, they need to collect a sales tax when you are purchasing something online in order to avoid the shortfall of revenue for the states. Now, let us now next move to the general sales tax. You can think about the general sales tax as an alternative income source to supplement government finances. Because it is a tax on consumption, the tax base is usually very broad, and there's also a large revenue generating capacity. The tax revenue also implicitly includes wealth and income. Because remember, you may have a very low income, but a lot of wealth, then the income tax would only capture your low income. Whereas if you're having a consumption tax, then you are not only based on your consumption, not only depends on income, but it also probably depends on wealth. A consumption tax could also promote economic growth because it discourages consumption and encourages savings, which can then be used for firms to invest. Now, there are two types of general sales taxes. One is the retail sales tax, which is used in the United States, and that is only levied at the last stage of production. This is usually used by US state and local governments, as well as some Canadian provinces. On the opposite side, you have the value-added tax, which is, again, it's a multi-stage tax, which is applied to each transaction, but every purchaser is exempt on the items purchased. Note that the value-added tax is a requirement for membership of the European Union, and it is also used in China, Russia, and Latin American countries. Now, let us first have a look at the retail sales tax. Some goods for the retail sales tax are excluded due to concerns about efficiency, equity, and also to avoid hindering economic growth. For example, I mentioned before that the sales tax is not levied on purchases from firms, and it's only at the retail level and not the wholesale or the manufacturer's level. Sales taxes are also composed of various components in the sense that you can have a state sales tax, but then there may also be local and special rates. So for example, you have in New York City, you have a 4% state tax, but then you also have a 4.5% city tax, and then you additionally have a 0.375% metropolitan commuter transportation district surcharge. So your total sales tax in New York City is actually 8.875%. Note that 5 states do not levy a retail sales tax, and those states are Alaska, Delaware, Montana, New Hampshire, and Oregon. Here you see a graph of how the sales tax, the revenue from the sales tax, has evolved over time in the states. So you have on the vertical axis, you have the percent of general revenue by states. And you can see that the revenue from the sales tax has decreased over time, and that the revenue from local taxes has increased, or from local sales taxes has increased over time. Retail sales taxes can also be differentiated by coverage and rates. Coverage refers to the types of items that are actually covered by the sales tax. It can be general in the sense that it applies to all transactions except for certain exemptions. Think about energy or think about services. But it could also be selective, where it is only applied to certain transactions. You can think here about a lodging tax, for example. Then there are also differences in terms of rates. The rates can be specific or ad valorem. Specific means that the tax is applied to physical units bought or sold. So this is sometimes called a per unit tax. The most famous one is probably the fuel tax in the United States. So here, and this depends on the state or the federal level, you can have 20 cents specific tax per gallon of gasoline purchased. Note that if you are having a specific tax or per unit tax of, say, for example, 20 cents, then this may also lead to issues associated with inflation if the tax rate is not updated every year. Then you could also have an ad valorem tax, which is basically according to value. So think about this, the previous lodging tax could be, for example, 10% of the hotel bill. Now note that the drawback of the ad valorem tax is that it really depends on the price of the good. If you're thinking back about the gasoline consumption, we have seen that gasoline prices and diesel prices have had significant fluctuations over the last year. So that would also mean that the value, the tax revenue, would also significantly vary if it was an ad valorem tax, whereas the consumption of gasoline remains relatively stable. Now next, let's talk about the value-added taxes, or also called VAT. The value-added tax works as following. The tax is applied at each stage of production, but only to the value added compared to the previous stage. This avoids that the tax is cascading in the sense that, for example, the sales tax, if it was at every step, would be added and increased at each step. There are three types of value-added tax systems. There's the credit invoice method, the subtraction, and the addition method. So let us have a look of how exactly the VAT works under those various systems. So consider the following, and here we are only going to look at the credit invoice versus the subtraction method. Suppose the following: you have a farmer, a miller, and a baker. And in the absence of any taxes, the farmer has sells the wheat for $300 to the miller. Then the miller sells the flour to the baker for $700, and then the baker charges $1,000 for the bread. Okay, so here there is no tax in this first case, and hence the tax revenue is 0. Now, if we have a retail sales tax of say 10%, then the sales tax is not applied to the farmer or the miller, and it is only applied to the baker, that now has to increase the price on bread from $1,000 to $1,100. And hence here, with the general sales tax, you have the retail sales tax, you have a total tax collected of $100. Now note that with the value-added tax, you are only charging, again, 10%, but you are charging it on the value added. In the sense that the farmer has added a value of $300, and hence if we have a VAT of 10%, then the value added is $30, which is the $300 plus the 10% tax, the $330. Now the miller is adding a value of $400, and hence the miller is actually just going to have a tax of 10% on the $400 that they added to the product. However, the tax still applies to the entire price, in the sense that we now have 10% on $700, which leads to $770. However, the miller can actually get a tax credit or a tax refund based on the tax paid by the farmer. So here's how this works in general. So let us look at the last line. Keep in mind that here the value added is $300 by the farmer, $300 by the farmer, $400 by the miller, and $300 by the baker. Having a value-added tax of 10%, that means that the farmer pays $30, the miller pays $40, and the baker pays $30. Now, the difference between the credit invoice method and the subtraction method is that with the credit invoice method, you actually have two paper trails, in the sense that you have a tax liability, but you also have a tax credit. So each of those three people have a tax liability of $30, $70, and $100, but they also have a tax credit based on the value-added tax they have paid before. So here, the miller only pays $70 minus $30, $40, and the baker only pays $30, which is $100 minus $70. Now here, in the credit invoice method, you actually have two paper trails, in the sense that you have a paper trail for the tax liability, and you also have a paper trail for the tax credit. Whereas under subtraction method, you only have a paper trail for the tax liability. In the sense that the credit invoice method computes the VAT on all taxable purchases by businesses and consumers. And we have the sales invoices that are showing the value-added tax collected. And we also have the purchase invoices from other business businesses showing the value-added tax paid. So in the sense that you have two types of records, you have the sales invoices and you also have the purchase invoices. Now with the subtraction and the addition method, we are actually having the value-added tax combined. In the sense that in the subtraction method, you only have the value added by the business and the business pays the tax on this value added. So this is the reason why in the previous section, when you have the subtraction method, you only have the tax liability of 30, 40, and 30, which is the value added by the various components. Note that the revenue generated and also the tax burden on each of the three stages is identical. You can think about the credit invoice system simply as a way of tracking the value-added tax. Now, when we are looking at the addition method, which is slightly different from the value-added tax, and this is not which is slightly different from the subtraction method, but it's not really used in practice. In the sense that, suppose that we have the following example. We have a company that sells $200,000 in goods. They have material purchases of $125,000 and they are also paying wages in the value of $50,000. Note that in this case, the profit to the owner is $25,000, which is the $200,000 minus the $175,000. In the addition method, the value-added tax is paid on the sales minus the material, in the sense that the tax base is $75,000, which is the $200,000 minus the material. On the addition method, you actually have also the value-added tax, which is paid on $75,000, but here it is based on the value added by the firm, in the sense that the wages, the $50,000, as well as the profits of $25,000. Now, if we are comparing the various sales taxes, then we have the farmer, the miller, the baker, and the retailer. And note that we have the sales of $100, $150, $300, and $400. You can think about this column representing the prices. So the value added by the farmer is $100. The value added by the miller is $50, which is the difference between $100 and $150, and so on. Now, if we have a sales tax of 5%, then the sales tax only applies at the retail level, and hence 5% of $400 are $20. Now, with the value added tax of $5, we only have the 5% on the value added. So 100 times 5% is $5, 50 times 5% is $2.50, and so on. And you can see that the revenue from the sales tax as well as the revenue from the VAT is identical. However, with the value added tax, you have the various stages of production that are actually taxed. Now, with a turnover tax of 2.11%, then you can see that you have the farmer paying $2.11, which represents 2.11% of $100. The miller would pay $3.16, which represents 2.11% of $150, and so on. With the manufacturer's tax, you would have to need a slightly higher tax rate in order of 4.44%, because the farmer as well as the retailer would be exempt. So here you can look at this table of the various sales taxes and how different tax rates lead to the same total tax revenue, but it also leads to a different burden of the taxes depending on who is paying the taxes. Now here in this graph, you actually see the comparison of the 2022 value-added tax rate in OECD countries. And as I mentioned before, that in all European countries, you do have a value-added tax. And you can see that in certain countries, the value-added tax, say for example in France, is actually at 20%. Note that this is very high compared to the sales tax we would have here in the United States. And the reason for that is straightforward, in the sense that the value-added tax is actually what is called a self-enforcing tax. Remember, in order to get reimbursed or to get a tax credit, if you are a business, you have to document the receipts of how much you paid at each production stage. In the sense that for each producer reports their sales to somebody else, and hence there is a paper trail that tracks all the various production stages and the value-added tax. So there's no incentive to cheat, or in the sense that it is very difficult to cheat. This is not true when you have a retail sales tax, where you usually, if it hits above 10%, that there is now an incentive to cheat, and the sales tax rates over 10% were not successful at their implementation. Next, we are going to have a look at excise taxes. Now, there are various rationales why you would have an excise tax, and remember that an excise tax is on a specific item. Usually it is meant to discourage the consumption of a particular item. So here you can think about alcohol and tobacco taxes that are sometimes also called sin taxes. You can also think that you may have externalities. Remember, this is something we have talked about in the first lecture, that with an excise tax on a particular product that is actually creating an externality, you can make consumers of that product internalize the externality. You can also have an excise tax as an approximation of the benefit charges. You can also increase the vertical equity if you are having a tax on luxury goods. And of course, an excise tax also is exporting the tax burden to non-residents. So here you can think about if I'm driving to Wisconsin or Minnesota, for example, then I am paying the gasoline tax in Minnesota, and hence there is the tax burden is then exported to me as a non-resident of Minnesota or Wisconsin. We are going to look at 4 types of excise taxes. We are going to look at what is called a selective excise tax. Then we are going to look at sin taxes, at benefit-based taxes, and then as well as regulatory and environmental taxes. Note that I am presenting different categories of excise taxes, but some of those categories are going to be overlapping. So let us have a look first at the selective excise tax, and here I'm going to take the example of a luxury tax. Basically, a luxury tax is the redistribution of government costs from high-income individuals or to high-income individuals and households. Here, an example would be the luxury and fuel-inefficient vehicle surcharge in New Jersey. Basically, you have an additional tax in New Jersey if your vehicle costs more than $45,000 or has a fuel efficiency rating of less than 19 miles per gallon. Note that this is a state level tax, but there has also been a federal level luxury tax that was introduced in 1990, but since it has been repealed since. That federal luxury tax was on planes, yachts, furs, and also jewelry. Now, a sumptuary excise tax, also known as a sin tax, basically discourages excess consumption of an item or of a good that is deemed unhealthy or unsafe for consumers or the public. Here, the most common examples are taxes on tobaccos and alcohol. Note that the sin tax here in this case is not only to protect somebody's own health, but there are also externalities associated with the consumption of tobacco and alcohol. So those sin taxes cover some of those externalities as well. It has been argued that sin taxes, such as on tobacco and alcohol, are not very effective at reducing the consumption of the good because the demand for those goods is very inelastic. There's an example in the New York Times from a couple of years ago, from 2005 to be specific, where they looked at the effects of increasing beer taxes on consumption. And they noticed that it may be the demand for tobacco and alcohol may be inelastic for the vast majority of the population, but it is actually very elastic for teenagers. That is, if there are small price changes in the price of beer or tobacco, that teenagers are actually very sensitive and reduce their consumption by a lot. And here this article basically analyzes the effect of beer taxes on teenage consumption and notices that the consumption is significantly reduced in that age group, or for that age group. Now, we also have benefit-based excise taxes that basically represent a charge associated with a public good and its finance. So here, the most common example of fuel taxes on gasoline and diesel that aim at maintaining and financing road infrastructure. Okay. Now here there's also there's the benefits principle, and it is basically a price for the public good. The benefits principle refers to the fact that the more you're using the roads, the more gasoline you are using, and also the more damage you are doing to the road. And hence, because you are using more gasoline, there's also a higher level of revenue associated with you using the road significantly. Note that the issue with fuel taxes is that it is a specific dollar amount per gallon and it is not indexed to inflation. And hence, the purchasing power of the fuel tax has been declining over the decades. Now, there are also regulatory or environmental excise taxes that basically aim at internalizing externalities that are imposed to society. So, for example, before I used tobacco and alcohol as sin taxes, on this example of sin taxes, but you could also argue that since tobacco and alcohol use may also impose costs to society, that there's also an externality that is covered with the sin tax. Other examples here are the gas guzzler tax, which is basically a tax on pollution, where pollution is considered an externality. Now, we have looked at the various consumption taxes, and now let us have a look at the evaluation of those sales or consumption taxes. Now, remember from previous lectures that the criteria to evaluate taxes are the efficiency, in the sense of what type of economic decisions are distorted or changed by the tax, and then what is the magnitude of those distortions. There's also the criteria of equity. Here we are talking about horizontal versus vertical equity. And then there's also the concept or the criteria of adequacy, in the sense of what is the revenue raising capacity that is associated with the tax and the tax base. Now, in terms of efficiency, we have to note that consumption taxes, by their very nature, are distorting relative prices. So, from an economic perspective, if you compare that from an economic perspective with the income tax, then the income tax is simply reducing your income. That is different from the consumption tax, because you may have the choice now to purchase goods that are exempt from the tax versus that are subject to the tax. Also note that here I write that it distorts relative prices, and that may lead to a loss in efficiency. But we have also seen in previous lectures that if you have, for example, a negative externality associated with a good, and you are imposing a tax, a so-called Pigouvian tax, then you actually restore efficiency. Also, the general sales tax, there is the demand and supply elasticities, in the sense of how reactive are consumers and firms to price changes, also determines the tax incidence on consumers and producers. There are also equity concerns, and we have touched on some of those already in this video, in the sense that low-income households usually spend a higher share of their income on consumption items. in the sense that if you're thinking about a family of 3, and you can think about that this family of 3 requires an income of, say, $20,000 to survive, then that $20,000 may be spent by a low-income household, but then the cost for a high-income household may actually be, say, suppose it's $30,000 or $40,000, but their income may be more than double. Okay, so hence there is this regressive nature of the sales tax. There is also the issue of vertical equity associated with excise taxes, in the sense that low-income households spend a higher percentage of income on energy, cigarettes, and alcohols. Okay. However, as mentioned before, you could potentially justify the excise tax, or the gasoline tax in this case, with the benefits principle. The adequacy refers to the fact of, well, how much revenue can be raised. And we have noticed before that since everybody is consuming, that there's a significantly or a very large tax base associated with general consumption taxes. And if you're comparing this, for example, to an excise tax, then an excise tax could potentially be very narrow and has a poor revenue raising capacity. Now, let us have a look at let us come back to the issue of equity. And I'm having an example about the sales tax evaluation in the next section. Now let us have a look of how we can improve vertical equity in sales taxes. So consider that we have 4 families and their income is $30,000 for family 1, and they have a family size of 3. We have a family number 2 that also has $30,000 in income, but they are 4. And then we have also family 3 and 4 with $36,000 and $90,000 of income, and the family size is 4 and 3 as well. Note that I have included here a family size cost adjustment factor, in the sense that in order to compare family 1 to family 2, they both have an income of $30,000. But note that family number 2 actually has, the size is 4 compared to family number 1. And hence, the family size adjustment factors here are 1 and 1.2. Note that the 1.2 is for both family 2 and 3, since they have 4 family members. So the adjusted income, to take into account that a family of 4 has more expenditures than a family of 3, we apply the family size cost adjustment factor. And so we do this by taking the income divided by the family size adjustment factor. So here the income would be 30,000 divided by 1.2, and that would leave us an income of 25,000 for family number 2. Note that family number 4, there is no adjustment factor, so they still have an income of $90,000. But the family number 3, here again we are going to divide the $36,000 by 1.2, and hence we get an adjusted income for family number 3 of $30,000. Okay. Now next we have some information about the purchases of those families. So we have the taxable purchases are reported in the line here. So you have taxable purchases with food of $18,000 for family 1, and you can see the other values for families 2 through 4 in this line as well. Note that I have separated out the food purchases from the taxable purchases for each of the 4 families. Now assume that here we have a sales tax rate of 5%, okay, that is applied on all purchases. So now let us have a look at the tax burden for each of those families given the existing tax system. So we have the $18,000 for family one, and they are paying 5% taxes on that, so you multiply this by 0.05, and hence you get the value of $900. For family number 2, you are multiplying the 5% by 22,500, and when you do so, you get taxes paid of $1,125. And if you do this for the other families as well, then you are getting taxes paid of $1,200 and $2,500. Now, when you are now calculating the effective tax rate based on the adjusted income, okay, so not on the income itself, but on the adjusted income that reflects larger family sizes, or that adjusts for larger family sizes, then you have the $900 divided by the 30,000 is equal to 3% for family 1. For family number 2, it would be the 1,125 divided by the adjusted income, which is 2,500. And hence the effective tax rate for family number 2 is 4.5%. For family 2, we have $1,200 in tax payments divided by 30,000. That gives a rate of 4%. And then for family number 2, we have 2.78%. Sorry, this is percent. Now you see that we have here the case of a regressive tax, where we have the family number 2 pays, say, 4.5%, and then the family with the highest income actually only pays 2.78%. And usually this regressive tax system is due to the fact that low-income families have spend a higher share of their income on purchases, on consumption, okay? Because they do not have the ability to save. Now the question is, well, how can we actually move this regressive tax system to a more progressive tax system? So next, assume that we have the tax system, but where we exempt food purchases from the sales tax. So the taxable purchases without food would be then $18,000 minus the $9,000 would be $9,000 for family 1. For family 2, it would be the $12,500 minus the $12,500. So we would have $10,000 for family number 2. For family number 3, we would have $10,000 as well. And for family number 2, we would have the $50,000 minus the $20,000, and hence we would have $30,000. Okay. Now the taxes paid would be simply the 5% on those purchases. So that would be $500 for family 1, $500 for family 2, $500 for family number 3, and then we would have $1,500 for family number 4. Now, when you're calculating the taxes paid based on adjusted income, so for example, the $500 divided by the $2,500, then you would have a tax system, or you would have an effective tax rate of 2% for family number 2, 1.67% for family number 3, and 1.67% for family number 4. Now we see that here, compared to family 1, family 4 is now paying a higher effective tax rate, but we still have the issue for family number 2 compared to, say, family number 3 and 4. So how can we further improve this? Now consider the following tax rebate system, where we have a rebate of $250 per person if the household income is below $40,000. Okay. So note that in this case, it is only families 1, 2, and 3 that actually benefit from the rebate and not family number 4. So now we have the rebate per person of $250. So the total rebate is 3 times $250, $750. Then for families number 2 and number 3, we have a $1,000 rebate, since there are 4 people in the household. And then there is nothing for family number 4, because the family number 4 has an income of over $40,000. Now, hence, when you are now looking at the tax after the rebate, and note that here we are comparing it to the existing system, then we have the $900 minus $150. Sorry, $900 minus the $750. This gives us the tax rebate of $150. Then we have the $1,125 minus the rebate of $1,000. That gives us taxes paid of $125. Then we have the taxes of $1,200 minus the rebate of $1,000 gives us $200. And then family number 4 still pays the full amount of taxes of $2,500. Now, when you're calculating the effective tax rate, then you can see that for family number 1, the effective tax rate is 0.5%. For family number 2, it is 0.5% as well, which is the 125 divided by the $25,000 of adjusted income. For family number 3, it is the 0.67%. And for family number 2, it is the original 2.78%. So now you can see that how you have converted a regressive tax system. You can convert that into a progressive tax system with the various rebates. Of course, you then have to also solve the question or the issue of how do you actually make up for the revenue which you're paying for in terms of tax rebates.